Welcome to Balance of Economy. Before we break down the data, please note that this is market research for educational and informational purposes only and does not constitute financial advice or a recommendation to buy or sell any asset. Let's look at the numbers. Okay, so if your portfolio has ever taken a massive hit right after some executive team promised, unprecedented growth, you probably know exactly why we are starting with that super intense tone today. Welcome to today's deep dive. We've got a really fascinating one for you.
Yeah, we're looking at a briefing from the Balance of Economy research team, and it's pretty uncompromising.
It really is. I mean, their whole thesis is built on this premise that the financial markets are basically split into two totally different realities. Like, on one side, you've got the theater of public relations and speculative hype.
Right, the short-term noise.
Exactly. And then on the other side, you have the mathematically ruthless reality of corporate accounting. And the whole mission of our deep dive today is to really isolate that second reality, to help you stop getting fooled by all the executive rhetoric.
Because it's so easy to get caught up in it. I mean, we're trying to figure out how to read true corporate intent, like in light institutional allocator, which means looking at how corporations actually deploy their most precious resource, which is their cash.
Yeah, and how you can track that deployment to basically front-run the broader market. Which is, the necessity of this framework just comes from the sheer volume of noise out there right now.
Oh, absolutely. Anyone with an internet connection has access to this limitless fire hose of forward guidance and earnings call transcripts.
Analyst upgrades, all of it.
Right. But the problem is most of that data is engineered to manipulate sentiment. It's marketing.
Yeah, it's totally marketing. And this source material provides a structural mechanism to just filter all that out and isolate the truth. Because it argues that by the time you hear about some massive macroeconomic shift on CNBC or whatever, the smart money has already positioned itself.
Long ago. Based on physical, undeniable capital allocation data that was filed, months prior.
So let's unpack this, because the briefing lays out a pretty brutal critique of retail trading strategies right out of the gate.
It really doesn't hold back.
No, it points out that millions of people spend their days just tracking minute-by-minute price movements, right?
Yeah.
Drawing geometric lines on candlestick charts.
Relying on metrics like the relative strength index or moving average crossovers.
Yeah, the RSI. And the briefing explicitly calls these out as lagging artifacts. But people treat them like prophetic tools.
Well, because it's a fundamental misinterpretation of how market mechanics actually work. Just look at the math behind a 50-day moving average. It's literally taking the closing prices of the last 50 trading sessions, adding them up and dividing by 50.
Right.
So by definition, it is a composite of the past. If you execute a trade because a short-term moving average crosses above a long-term one, you're buying the reaction to an event that already happened.
You're trading the exhaust fumes.
Exactly. You are trading the exhaust fumes of institutional decision-making. The core thesis here is that price is merely an echo.
I love that phrasing, the price echo. The candlesticks on your screen aren't the signal at all. They're just the delayed, lagging artifacts of these long-term capital allocation decisions.
Decisions that were made by corporate boards months or even years before the price ever moved.
Yeah, if you internalize that idea that price is an echo, it completely changes how you look at a stock chart. I mean, trading based purely on chart indicators, it's like driving a car while exclusively looking in the rearview mirror to predict where the road is going to curve next.
That's a great analogy. You're just reacting to terrain you've already covered.
Right. But okay, if we accept that price is just the echo, why do so many people, even professional analysts sometimes, rely so heavily on the rhetoric of executive teams to try and look forward? Because the briefing suggests that listening to an earnings call is almost as dangerous as trading purely on RSI.
Because public relations is remarkably cheap. I mean, the asymmetry of risk heavily favors the executive.
XL.
Well, an executive team can easily go on a major financial news network, sit under the bright lights, and just broadcast unbridled optimism. They use this highly engineered linguistic framing, words like pivotal transformation or unprecedented demand.
Oh yeah, you see those buzzwords constantly.
Right, and those verbal commitments cost the company absolutely nothing to produce. It's free airtime.
But the danger is that people believe it.
Exactly. The danger arises because institutional allocators, the sovereign wealth funds, the massive pension managers, They know these statements are entirely malleable. If macroeconomic conditions go sour 6 months later, the CEO can just blame geopolitical tensions or, supply chain bottlenecks.
Right. The narrative just gets rewritten with zero immediate penalty to the balance sheet. It's the classic principal agent problem at play here.
100%. The executives are the agents, and their compensation, their stock options, bonuses, their literal career longevity, it's often directly tied to maintaining high short-term sentiment.
So they are structurally incentivized to present the absolute most optimistic version of reality to Wall Street today, regardless of what the data actually says about tomorrow.
Right. And while retail algorithms might scrape an earnings transcript and detect the word unprecedented and just instantly initiate buy orders,
Yeah.
the elite allocators are looking elsewhere.
They're ignoring the cheap rhetoric.
They ignore the cheap rhetoric and search for expensive commitments. If you really want to know what an executive team believes about the future of their industry, you don't listen to their forward guidance.
You look at the strict boundaries of their accounting architecture, which brings us right to the fundamental divide at the center of this briefing, the split between operational expenditures and capital expenditures.
Yes, the OpEx versus CapEx divide.
Because every single dollar flowing out of a corporate treasury has to be categorized into one of these two buckets, and they have entirely different economic impacts. Let's break down operational expenditures, or OpEx, first.
So OpEx represents the short-term, day-to-day costs required strictly to keep the business alive and functioning in the immediate present.
So we're talking about what? Salaries.
Salaries, office rent, monthly utility bills, cloud software subscriptions, basic administrative costs, all of that is OpEx.
Stuff you just have to pay to keep the lights on.
Exactly. And from a strict accounting standpoint, OpEx is consumed instantly. The moment the cash is spent, its economic value is gone. It gets recorded directly on the income statement and is fully deducted from the company's gross revenues in the exact quarter or year it was incurred.
Yeah, the briefing states it pretty bluntly. It says, if a company stops paying its OpEx, the lights turn off tomorrow. It just maintains the baseline. But I actually want to play devil's advocate and challenge the rigidity of this framework for a second.
Okay, go for it.
Let's look at, say, a modern software as a service company, a SaaS business. They don't build physical factories, right? Their primary engine of growth might be this massive $50 million marketing campaign to acquire millions of new monthly subscribers, or maybe a huge research and development budget to code a new algorithm. Both marketing and most R&D are typically classified as OpEx.
That's true.
So doesn't this framework unfairly dismiss the primary growth drivers of the digital economy by just labeling them as mere maintenance?
It's a critical nuance, and honestly, it's a huge debate in modern accounting right now. But while marketing might build brand awareness and drive user acquisition, the framework we are analyzing remains ruthless for a specific reason, and that reason is fragility.
Fragility.
Yes, that $50 million spent on digital ads is still an expensive maintenance because it requires constant feeding. You bought attention, and attention is fleeting. The absolute moment you stop spending on that ad campaign, the user acquisition dries up.
Oh, I see. It doesn't create an independent, tangible asset that keeps generating value on its own.
Exactly. The same applies to many forms of R&D. Software code can be rendered obsolete overnight by a competitor who just builds a better algorithm. So the framework argues that OpEx, by its very nature, is an expense of maintaining present existence, even if that existence happens to be growing in user count.
That makes a lot of sense. So then contrast that fragility with capital expenditures, or CapEx, because if OpEx is about maintaining the present, CapEx is this aggressive investment in future reality.
Right. CapEx represents the long-term investments in physical, structural capital. This is the cash a corporation dedicates to acquiring, upgrading, or maintaining long-term physical assets that are specifically designed to expand future production capacity.
So we're not talking about Facebook ads here.
No, we are talking about clearing acres of land to build advanced manufacturing plants. We're talking about acquiring heavy industrial machinery or, signing 10-year power purchase agreements to construct multi-billion-dollar data centers.
It's highly tangible, and the mechanical accounting of CapEx is really what makes it so pivotal, isn't it?
Yeah. It is, because unlike OpEx, CapEx does not immediately hit the income statement as a net loss.
Wait, really? It doesn't show up as an expense right away?
Not in the same way, no. The money definitely leaves the treasury, but because that new factory or that data center is going to generate economic value across a multi-year horizon, the cash spent is capitalized. It lands on the balance sheet under the asset class known as property, plant, and equipment, or PP&E, And from there, it's gradually expensed over its useful life through depreciation.
Okay, so the physical permanence is the real differentiator here. I mean, you and I can visualize a multi-billion-dollar data center packed with specialized hardware, humming with electricity. You can't just easily retract a data center.
Exactly. When a board of directors authorizes a massive expansion of CapEx, they are taking their liquid cash, which is the safest, most flexible asset a company has, and voluntarily locking it up.
Into highly illiquid, permanent physical structures.
Yes. This is why the briefing refers to the balance sheet as mathematically ruthless. What's fascinating here is that you cannot use linguistic framing to manifest thousands of tons of concrete or specialized cooling towers into existence. You either bought them or you didn't.
So an expanding CapEx budget is the unvarnished blueprint of true corporate conviction.
That's exactly what it is.
It kind of reminds me of, like, it's the difference between your friend who posts a long social media thread about how they're going to start training for a marathon.
Right. The rhetoric.
Exactly, the rhetoric. Versus the friend who quietly spends their life savings building a professional running track in their backyard. That's the CapEx. You know exactly who is actually going to run the marathon.
That's a perfect way to look at it.
But wait, I do want to push back a little on this idea of true conviction always equating to infallible strategy.
Yeah.
What about malinvestment? I mean, we've seen massive historical examples where corporate boards had incredible conviction, spent billions on CapEx, and were entirely wrong.
Yeah.
Like, look at the late 1990s telecom boom. These companies laid thousands of miles of fiber optic cables across the ocean floors, astronomical amounts of CapEx. But the demand didn't materialize fast enough, the sector imploded, and massive write-downs followed. Doesn't that prove the balance sheet can be just as detached from reality as an earnings call?
Well, it proves that executives can miscalculate timing or aggregate demand, yes. A CapEx authorization is certainly not a guarantee of future profitability. However, the CapEx signal itself was structurally true regarding corporate intent.
True intent, yeah.
When those telecom executives said they believed the internet was going to require massive bandwidth, they weren't lying. Their CapEx proved they believed it, to the point of risking bankruptcy. And the write-down you mentioned, that is the ultimate proof of the balance sheet's mathematical ruthlessness.
Because they couldn't just brush it under the rug.
Exactly. When the CapEx bet fails, the asset must be impaired, and the company takes a massive, undeniable hit. Compare that to a failed PR campaign, which simply vanishes into the ether. Even in failure, CapEx provides an honest accounting of where capital was actually deployed.
That's a really vital distinction. And honestly, while the individual telecom companies may have gone bankrupt, the physical infrastructure they built laid the groundwork for the entire modern digital economy.
Right, the capital was real, the assets were real, and eventually the utility was realized by the broader market.
So CapEx doesn't mean the company will definitely succeed, but it proves they are playing with live ammunition. If a CEO is on television claiming some historic wave of demand is imminent, but their financial filings show their CapEx budget is flat or declining, it's just an illusion.
They're unwilling to deploy the live ammunition.
Conversely, if a company is quiet, maybe their stock price is just consolidating, but they are quietly locking up billions in illiquid infrastructure. They are betting their corporate existence on a future the broader market hasn't priced in yet.
Which is exactly why we have to move past simply understanding the theory and get into the actual mechanics of data extraction.
Yeah, how do we actually track this without, like, manually counting concrete trucks outside a factory?
Right. The briefing demands that analysts stop observing passively and start interrogating the statement of cash flows. To build a repeatable investment edge, we have to isolate the specific data buried under the investing activity section and calculate 3 specific metrics of corporate intensity.
Okay, let's walk through those 3 quantitative metrics of true corporate belief. The first one is year-over-year CapEx velocity. And the formula seems pretty straightforward. You take the current period's capital expenditures, divided by the prior year's capital expenditures of the exact same period, and subtract 1. So it's basically just measuring the rate of change, right?
Exactly. Velocity measures momentum in the physical world. It tells you how aggressively a company is ramping up its physical footprint compared to its own historical baseline. The briefing outlines a scenario where this metric becomes highly predictive. Imagine a company whose stock price is moving sideways. Retail sentiment is totally dead.
Technical indicators are completely flat.
Right, but underneath the hood, the company's CapEx velocity quietly accelerates from a baseline of, say, positive 5% to positive 35%.
Okay, here's where it gets really interesting. Because what does a 35% acceleration actually look like internally? That means the board of directors is aggressively securing debt, finalizing massive procurement contracts, scaling operations. They are panicking in the best possible way.
Yes, the insiders who see the purchase orders and the underlying customer demand way before it hits the public ledger are rushing to build the physical capacity. They're trying to capture a wave of revenue that hasn't even materialized on the income statement yet.
And by the time that revenue is publicly reported and the retail market reacts, the value has already been captured by the early allocators.
Precisely. You are tracking the preparation for revenue. Now, the second metric scales this against the company's current size. That's CapEx to revenue intensity.
CapEx intensity. And the formula for that is total capital expenditures divided by total revenue. So this measures what percentage of the top-line revenue a company is actively diverting away from immediate profit margins to reinvest into physical capacity.
The margin sacrifice is the key element here. Wall Street analysts generally hate when companies sacrifice short-term profit margins. So if a low-margin hardware business historically operates with a CapEx intensity of 5%, and suddenly that intensity doubles to 10%, the stock might actually take a hit in the short term.
Because their free cash flow is suddenly compressed.
Right. But structurally, what does that jump signal to an elite allocator?
What does it signal?
It signals a critical industry capacity constraint. The company realizes it literally cannot fulfill incoming demand with its current physical footprint. Management is willing to take the short-term punishment from Wall Street because they know that failing to build capacity right now means losing market share in the future.
So they are sacrificing the short-term stock price for long-term survival and dominance.
Exactly. And the inverse is equally revealing. The briefing notes that if a mega-cap tech stock has growing revenue but its CapEx intensity is actively falling towards zero, it means the company is just coasting on legacy infrastructure.
Oh, wow. So a declining CapEx intensity in a growing company is actually a massive warning sign.
It's a huge red flag. It suggests that management looks out at the economic landscape and sees limited high-return opportunities. They have no compelling reason to build anything new, so they are simply milking the cash cow they built 5 or 10 years ago.
Which might result in high free cash flow and stock buybacks today, but it indicates a totally stagnant growth horizon for the next decade.
Exactly.
Okay, that brings us to the third and easily the most extreme of the quantitative indicators, CapEx to operating cash flow coverage. The formula here is capital expenditures divided by cash flow from operations. So we are measuring how much of the actual hard cash generated by the company's daily operations is being consumed by physical investments.
Yes. This metric separates the maintainers from the absolute aggressors. If a company's CapEx consumption approaches or even exceeds 100% of its operating cash flow, you are looking at a maximum conviction play. It is a bet the company maneuver.
Wait, really? If coverage approaches 100%?
Yes. They are taking every single dollar the business generates internally and shoving it straight back into the ground to build more capacity.
That is wild. Because
Yeah.
if coverage exceeds 100%, they are literally outspending their operational engine. That means they are forced to dip into their cash reserves or issue new equity or take on significant debt just to fund the physical build-out. They are leaving zero margin for error.
Zero. If the macro environment shifts and demand falls, the debt servicing on those new facilities could absolutely crush them.
Right, which is why boards of directors do not authorize greater than 100% coverage ratios lightly.
Not at all. When you see a coverage ratio that high, you know the board is fundamentally convinced that the future belongs to whoever possesses the most physical capacity. They are willing to risk severe financial distress to ensure they are the ones who capture the bottleneck.
Okay, so we have the theoretical foundation, and we have the quantitative dashboard. We know how to extract velocity, intensity, and coverage from the filings to completely strip away the rhetoric. But, extracting data is really only half the battle. How does an institutional allocator actually deploy capital based on this data?
Great, because knowing a Tier 1 hyperscaler is building a $5 billion data center is interesting, but buying their stock might not be the most efficient way to generate alpha.
Right, which transitions us perfectly into the briefing's strategic execution playbook, which it calls the quantamental framework.
Yeah, the quantamental approach. It blends quantitative screening with fundamental supply chain logic. The professional allocator uses a two-step framework to determine not just what to buy, but precisely where in the value chain to position their capital.
Okay, step one is fundamental selection, which is designed to avoid market hype. So the goal is to screen the entire market for companies exhibiting high CapEx intensity and accelerating CapEx velocity. But crucially, focusing on those whose underlying stock price is artificially depressed or ignored due to short-term market noise.
You are basically searching for the structural disconnect. You want assets trading at a significant discount to their intrinsic fair value, or you have mathematical balance sheet proof that management is actively constructing the infrastructure for tomorrow.
So you are buying the silent builders while the rest of the market is chasing the noisy promoters.
Exactly. But step two is where the actual alpha generation occurs. The briefing details the supply chain front run. This strategy revolves around tracking the massive capital deployments of the Tier 1 industry leaders to map out where that cash must inevitably land next.
Let's explain the physical mechanics of this domino effect.
Sure, let's construct a realistic scenario. Imagine the top 4 mega-cap technology companies in the world. We'll designate them as Tier 1, publicly confirm through their filings that they are expanding their combined CapEx budgets by $50 billion.
Over the next 24 months, say, specifically to build advanced data centers for artificial intelligence computation.
Right. $50 billion of authorized CapEx. When the retail market sees that headline, the immediate instinct is to buy the stock of those top 4 Tier 1 companies.
Right, because the logic seems sound on the surface.
Right.
They're investing heavily, therefore they must be growing. Let's buy their stock.
But they are buying at a massive premium, chasing a headline that is already fully priced into the mega cap valuation.
And that is the exact opposite of what the elite allocator does. Because the allocator recognizes that the $50 billion is an expense for the Tier 1 companies. That cash is leaving their treasury. The vital question is, whose treasury is receiving it?
Exactly. The Tier 1 companies are not mining their own copper. They are not manufacturing their own specialized optical transceivers. They certainly aren't fabricating the advanced industrial chillers required to cool the server racks.
They are reliant on a deeply entrenched, highly specialized network of Tier 2 and Tier 3 suppliers.
Precisely. That $50 billion of CapEx must structurally hit the top-line revenue of the companies contracted to build the infrastructure. The playbook dictates that you immediately allocate capital into those specialized component manufacturers, the raw material producers, and the niche engineering firms holding the exclusive procurement contracts.
This is the front run. I mean, it's brilliant. You are analyzing the supply chain to identify, say, a small-cap company that manufactures advanced thermal management systems. Their current stock chart might look entirely uninteresting. The retail crowd has no idea they even exist.
But, mathematically, that they are positioned downstream of a $50 billion tidal wave. The Tier 1 companies have already authorized the capital. It is simply a matter of time before that CapEx flows down the chain and manifests as explosive top-line revenue for that Tier 3 supplier.
And the friction in the supply chain is what creates the opportunity. Yeah.
Absolutely. There is a lag between a Tier 1 company authorizing CapEx and a Tier 3 supplier recognizing the revenue. It involves procurement contracts, backlog accumulation, deferred revenue accounting.
So by tracking the initial authorization, you are positioning yourself in the supplier stock before their upcoming quarterly earnings report inevitably shocks the market with a massive revenue beat. When the retail crowd eventually rushes in to buy the supplier on the news of the earnings surprise driving the price up, you are already positioned to sell into that newly created liquidity.
It is a profoundly elegant strategy because it entirely insulates you from the emotional volatility of the market. You're not trying to guess whether market sentiment will be bullish or bearish next month. You're simply tracing the inescapable gravity of billions of dollars moving from one corporate balance sheet to another.
It relies on the physical reality of commerce rather than the psychology of the trading floor.
It really forces you to operate as an architect of value rather than just a speculator of price.
Which perfectly encapsulates the ultimate separation in the financial markets that the briefing establishes. On one side, you have millions of market participants trading the transient noise. They're reacting to geometric lines, lagging technical indicators, and the linguistic gymnastics of executive teams.
And on the other side, you have the value protectors. They recognize that short-term price action can be heavily manipulated by algorithmic liquidity and speculative fervor, but structural corporate capital allocation, pouring millions of tons of concrete, locking up billions in physical assets, that cannot be faked.
No, it can't. When the board authorizes the cash transfer, the paper narrative dies and the industrial reality takes over.
Stop listening to what executive teams say and track exactly where their money goes.
It's a deceptively simple mandate, but it requires rigorous execution. As we wrap up this deep dive, I want to leave you with the exact mandatory outro from the source document, because it mirrors the intense, unflinching tone we opened with, and it perfectly seals the thesis of the balance of economy team. In a market this split, you're either a momentum chaser or a value protector. I'm tracking both in real time. If you want to see which side of history wins, subscribe to Balance of Economy. I'll see you in the next briefing. Stay sharp and stay informed. But before we officially sign off, I do want to leave you with a final provocative thought to mull over on your own. We have spent this deep dive establishing that tracking CapEx and front-running the supply chain provides a massive edge, precisely because human market participants are slow to process the deep structural layers of a 10K filing.
Right, there's friction and latency in understanding the supply chain.
Exactly. But what happens in the very near future, when artificial intelligence is the entity analyzing these balance sheets? If an AI system can strip away executive emotion, parse a 300-page financial filing in microseconds, and instantly execute trades to front-run the Tier 3 supply chain the absolute millisecond the data goes public on the SEC servers, will these structural inefficiencies disappear entirely? Will the lag time that allows the quantamental strategy to work just be compressed to zero? Or, this is wild to think about, are we going to see a bizarre new era of algorithmic CapEx warfare, where major corporations intentionally try to obscure, delay, or creatively account for their physical build-outs just to hide their strategic direction from the machines? Just something for you to consider the next time you look at a stock chart. Are you looking at the echo, or are you looking at the architecture? Thanks for joining us on this deep dive.